Thank you. The next question is from Rajgopal Tampi. Can you please unmute yourself and ask your question? Thank you. Please limit. Rajgopal, can you please unmute yourself and go ahead? Maybe we'll just take the next question from Manish Adukia from Goldman Sachs. Manish, please go ahead.
Yes, hi. Good evening. Thank you so much for taking my questions. My first question is if you can just help us understand what's happening in the competitive landscape. And this is across both beauty and fashion. Now, in beauty, we keep reading that some of the larger Indian conglomerates are getting slightly more aggressive on the beauty side. So are you seeing any signs of that in your business at all, or given just the differentiation that you talk about, there's really not any material impact? And same question on fashion as well. I think when you look at the quarter and you called out, there's definitely seasonality in your business, but the fashion business GMV was flat quarter on quarter. So is part of that also a function of the fact that competition potentially has been a lot more aggressive? I mean, we know that, for example, Reliance certainly has been fairly aggressive in the fashion side. So are you seeing any impact of that on the growth as well? So we'd love to get your thoughts on both those verticals.
Yeah, honestly, I think many of you all are in a better position to judge competitive landscape than us. All I can say is that what we hear from our brand partners mostly in terms of our role relative to other competitors' role, we do hear that on the beauty side, many of the large partners continue to want to work with Nykaa because of the size and scale and the organized manner in which Nykaa works with them to deliver their numbers. And I can ask Anchit to comment more on that. Anchit, would you like to comment?
Yeah, sure. So again, I think we can just share, whatever we have, whatever we hear from our partners and whatever we see in the business day to day. So what I would say is that, look, we've always said the horizontals, like the horizontal marketplaces have been around since 2012, 13. So they're not new. Then you've got some of the direct to consumer guys who were, who I think made a big push earlier in the first half of this year, as well as some of the other smaller vertically specialized beauty retailers. And I think what's happened is that there was a lot of noise, especially around November, December, when we were going public. I think a lot of competitors used it as a time to relook at the beauty space and to throw their hat into the ring. But I would say that from what we're seeing on the ground, the competitive intensity seems to have reduced actually since then. Our hypothesis is that there are probably larger markets for the larger horizontals to fight for. We believe obviously groceries, electronics, fashion are larger addressable markets. And I think that's where a lot of the horizontals and some of the new entrants, as you mentioned, will probably focus their time and energy. And so there was some additional focus on beauty from the larger players in the interim, but that seems to have receded. Now, if some of the local companies that you mentioned do decide to get into beauty in a big way, like we've all seen in the news, I actually think it's going to be a good thing for the market. Till date, Nykaa has single-handedly built the beauty industry in India, obviously with the support of our brand partners, but is the only retailer of size and scale in the market and a retailer focused on education and building awareness for beauty consumption. We've helped build the market to where it is today. So in our point of view, some healthy competition and companies who are willing to invest in the Indian beauty ecosystem and help to grow the market could in fact have a positive impact on us. So that is a short, I guess a long answer, but try to explain to you the different parts of the competitive spectrum.
I think jumping in on fashion, the way I sort of look at it is first and foremost, just taking a step back, the massive size and opportunity of the fashion market. You're talking about a $125 billion industry by 2025. You're talking about 25% online penetration. And, internally, the way we think of it is even if you're able to get 5, 10, 15% of that online pie, this is a very, very sizable business for Nykaa. So at least for us personally, we're not, lifting our heads and looking at competition left and right. I think we're really focused on trying to build something that is differentiated. And at least for me, maintaining and protecting that differentiation is the number one priority, and that's our right to win. So I'm not obsessed with, gaining market share at the cost of the other folks. It's more about let's get the part of the pie that we really like and we really believe in. Moving forward, you sort of touched on what about the growth over the last couple of quarters. I personally am trying to look at the business on a year-on-year basis rather than a sequential quarter basis. I think on a year-on-year basis, we're talking about 168% GMV growth. We showed you some slides that compared the fashion journey to the beauty journey. By any metric, the fashion growth has been explosive over the last couple of years. So I'm personally trying to look at it on year-on-year. The thing with sequential quarters is that there's always one, seasonality at play. Two, there are always judgments you take every quarter when you're trying to, again, balance the profitability and growth equation. And three, in every quarter, I'm always trying to set up the right marketing metrics that takes us into the next year and really fuels us for the next year. So, not sort of saying that the sequential growth that you've seen is what you will continue to see at all, but just saying that I'm trying to look at it on a year-on-year basis.
Thank you. The next question is from the line of Rohit Chodia. Rohit, please go ahead.
Yeah, thanks, Vijit, and good evening, everyone. Just three small questions, just trying to understand your numbers better. One, the bridge between your NSV and revenue from ops for various segments. If my understanding is right, the bridge in fashion, in the BPC segment would primarily be ad revenues. Fashion would be two elements: ads, which is a kicker, and then there is a take rate element. If you could just throw some light on this bridge in the two segments.
Yeah, I think that's correct. So NSV, so BPC is a inventory-led model, so revenue is quite similar to NSV, except that there's an incremental revenue on advertisement, which is not part of the product revenue. So that's correct. And in terms of fashion, yes, NSV is a number which is what customer pays net of taxes, and what we get in P&L is commission that we earn from the brands, because it's a predominantly marketplace business, but we also get some revenue on advertisement even in fashion, and we also get some revenue on shipping fee, etc.
Thank you. Second question: how has this matrix shipments per order moved? So let's say against the 32 million orders last year across the two segments, what were the number of shipments? I'm just trying to understand, are you still breaking your orders into multiple shipments to ensure better consumer experience?
I think we have some data on that. We do send the Lux orders separately. However, if you see during beginning of the year, because of COVID, April, May, June, our split shipment ratio was very adverse, which has since been brought down. And there is improvement in that. Plus, we also now have regional warehouses, and thereby reducing our air shipment costs. So we are doing a fair amount of work to manage our fulfillment costs better. And you will see the benefit of that going forward. Arvind, do you want to comment?
Yeah, I just wanted to add one thing. I think, actually, we believe that split shipment, consumer getting multiple packages for the same order is not a good consumer experience. And so we've always been focused on bringing that split shipment ratio down. What I would say is it was never that adverse for us. We've never been a company that has had a very adverse split shipment ratio. I think it was slightly more adverse than usual in the first couple of months of the year because of the COVID impact. But all of the investment we've made in building out a good regional network of warehouses and also better inventory management across our warehouses, I think that is the investment that you've seen in the fulfillment expense numbers in terms of building out the capacity. But you will see we're starting to see the benefit of that in terms of the split shipment ratio coming to very, very healthy levels in the past couple of months. And as a result, the consumer experience is obviously better. And of course, the fulfillment expenses also are trending lower.
So just quick last question, if you could give us a sense of the breakup of your marketing spends, between performance and brand.
So that is not there on this presentation, and unfortunately, as a result, we won't be able to share it. But I don't know how to guide you on that, but because it's not just performance and brand, there are also support and fixed costs of managing the MarTech function. So unfortunately, we won't be able to. But as a philosophy, we would like to spend predominantly on performance marketing with some conscious budgets towards brand marketing so that we have a healthy upper funnel growth.
Thank you. The next question is from the line of Sachin Dixit. Sachin, please go ahead.
Hey, hi, thanks for taking my question. I quickly had a question regarding AOVs in BPC in particular, right? So if we use the last 3-quarter numbers and we look at the annual AOV that has been released, AOV seems to have dipped quite sharply in Q4. Like it has dipped to 1660, roughly, if my math is right, from somewhere like 1960 sort of a number in Q3. So is that normal? Should or there are some other factors that are driving that?
Yeah, maybe I'll come in here. So I think there is obviously a seasonality in AOV numbers also. If you look at Q4 AOV 1763 in BPC, which is quite similar to last year same quarter. So last year also it was 1732. So part of it is seasonality, part of it also because we have actually invested back the efficiency that we realized into fulfillment network expansion, right? We spoke about moving from national fulfillment strategy to regional fulfillment strategy by expanding fulfillment centers regionally closer to customer. That has brought down our cost of shipment. So our unit economics has improved, and some part of it we are plowing back by reducing the minimum shipping value that a customer can book a free shipping for. So in Q4, we have reduced our shipping threshold to make it more affordable to, let's say, tier 2, tier 3 or mass customer who is conscious about shipping charges. And that also brings down a little bit of AOV versus what we were having in, let's say, in H1. So it's EBITDA neutral in a way that, the efficiency that we get from fulfillment cost reduction, we are plowing it back to make it more affordable to customers. Reaching deeper and nearer to customers.
Got it. Thanks. Just one more question quickly on ordering frequency. So in fashion, for example, we do understand like there are a number of new users who came into picture in FY22, which could have driven the ordering frequency down to something like a 2.97 for the year. How do you see this ordering frequency panning out over time? Like, do you see this will mature at somewhere around this 3.5 sort of a range, or it can go up to something like 5 or plus?
So to be honest, from a consumer cohort behavior perspective on beauty, we had a very sticky and very valuable cohort, and we used to see all individual cohorts behave in a similar way, making us believe that was an inherent customer behavior. To some extent, it was like a little bit affected during COVID period because mainly makeup having been affected, out of that cohort, and skin and hair and personal care had gained a bit. So there were these contrasting trends. However, that beauty cohort behavior is coming back to pre-COVID levels, but still a little more way to go for the entire amount of large celebration and the entire all the patterns of out-of-home behavior coming back in full scale. As they come back in full scale, you'll see more positive impact. Definitely fashion is in very early stage of our growth journey, with fashion customer cohort reasonably good in terms of repeat customer behavior, but needs a lot more working on to get them to the level of repeat customer behavior that we see in beauty. But we will work on it, and we do believe that fashion is also a category where consumers engage with the category pretty similar number of times as beauty, I would think, and hence they should be similar in the long run.
I'll supplement that. I think frequency of ordering could actually go up because of two reasons. As we spoke earlier, that some of the adjacent categories are growing faster because of better focus and assortment that we have brought out there. And some of it is coming through personal care as well. And in those kind of category, it is generally more higher frequency versus makeup, skincare, hair in terms of order pattern of ordering. So that could expand frequency of ordering, and also because we have brought down the shipping threshold to 300 rupees. So many customers might put smaller orders, but more frequently. But like I said, we are giving more assortment and choice and getting closer to customers. So we believe that getting more orders and more frequently will not strain the P&L. Rather, on an annual consumption value basis, I think we will be positive to get larger wallet share from the customers.
Thank you. The next question is from Nihal Jha. Nihal, please go ahead.
Hi, good evening. Am I audible?
Yes, please go ahead.
Yes, thank you so much. First of all, congratulations on the strong performance. A couple of questions from my side. First, on the fashion business, I just had this observation. I know we're looking at it on an annual basis, that our monthly average users has been more or less similar at around 16 million, whereas the transacting users, which is something that has been increasing every quarter. And even in the previous quarter, we did mention on the focus on conversions. So I just wanted to confirm again that even this quarter, the same thought process continued, that the focus is on conversion rather than getting customers into the funnel at this point in time?
Yeah, it's a very interesting question, Nihal. And I will tell you that as a company, we are very focused on upper funnel. We are very focused on middle funnel and also lower funnel. And while our primary objective is to focus on conversions also, but we also have to keep an eye on adding healthily on the upper and middle funnel, you know. So multiple objectives, but very good stronghold on marketing, both from data perspective and what we are doing perspective, so that we are able to optimize the best outcomes.
Sure. So
what I would not say is that TV ads never make sense because they are upper funnel. I think every type of marketing has a role to play, and we would do a mix. And there is a very big emphasis on CRM, because for a large customer database, which is very active for us, in beauty, CRM should be a very big focus, and so should it be for other areas also.
And if I may just follow up that going forward, the focus would be that this number keeps increasing so that it keeps feeding on into transacting customers into the future.
Yeah, absolutely. I think conversion is something that as a company, we're very, very focused on. We want to do more with the visits that we're getting. And as we say internally, conversion is the work of so many things. So relentless focus on assortment, price, availability, along with product marketing features as well. So yes, that remains a focus. And to me, an improvement in conversion is just a constant reflection that you're strengthening the platform and doing the right thing for the customer. So that will always be a focus.
Sure. Thanks so much. The second question was, I'm so sorry.
Nihal, sorry, if we can just fit in Shirom Kapoor, who is the next question here, and then you can jump back into the queue if possible. Can we please take the next question from Shirom Kapoor?
Hi, am I audible?
Yes.
Hi, thanks for the opportunity. I just wanted to ask one question. I see that, in the balance sheet, the other financial assets have increased considerably this year compared to last year. Is that, primarily a function of, proceeds from the IPO that have gone into your deposits? And, just if you could give some color on how you plan to deploy, are those the same funds from the IPO that, you plan to deploy the same strategy as mentioned during the time of the IPO?
Yes, the IPO funds will be deployed in the same manner as disclosed in the IPO document. But we also have funds available through our profits that we are generating, cash flow that we are generating. But we continue to want to invest in stores, warehouses, and also some amount of investment is in new businesses, and also some amount of investment is in inventory that we need to do our business better. Of course, it's been a tough environment from supply chain perspective, so we've taken a little bit higher inventory bets, so that we are, we don't face supply shortages. So, but similar as what we've been doing.
Thank you.
Okay. Great, thanks.
Thank you, Shirom. If I can, squeeze in a question of my own here. I was just looking at the Superstore expansion number, Falguni, and it went from 4,500 to 18,000 in this quarter. And you did mention about some feet on street hirings to, add these retail stores. So just trying to understand, are those stores acquired solely through feet on street, or there's a little bit of self-serve there as well? And
there is an element of self-serve also, but these are very early days. Also, the business had a good scale up in that quarter. However, when that happens, we also have to keep building infrastructure to service that network. So I think in early days, it's very difficult for us to predict quarter-on-quarter growth, because sometimes, our networks are slow at expanding in line with the demand that we see. So I think in early days of beauty, we learned that one thing we should do is believe in that growth and invest in infrastructure ahead of the growth. And I think that is, to some extent, we are doing it for beauty with our store rollout, with our even physical store rollout, as well as our warehouse rollout. And we'll have to do something similar even in the B2B business.
got it. Thank you. The next question is from the line of Garima Mishra. Garima, please go ahead.
Yeah, thank you so much for the opportunity. I had a couple of questions on the fashion business. Any timelines that you may have in your mind as far as when this business can become EBITDA positive? And also, now that you're seeing a much larger number of transacting customers in Nykaa Fashion, is there any material change you observe as far as customer behavior on order returns are concerned?
I think we can't make forward-looking statement on break-even, but if you know Nykaa, we are always working towards that magical EBITDA break-even for each of the businesses as early as possible, but in a manner that we are not depriving the business of a medium to longer term growth. So I think it'll be a balance and affordability also in terms of what we think is something that we would like to spend to build that business. But I think for most of the e-commerce business, showing near-term profitability is a matter of stopping customer acquisition, but it's not really the right thing. If you're acquiring the right customer, it is worthwhile to acquire that customer from a long-term value creation perspective.
Yeah, and I think in terms of the next question around returns, that's something that we've not split out, and therefore it'll be difficult for me to comment. But what I will say is that I'm very focused on making sure that we're getting a very high quality customer. So we're really trying to keep out kind of that often fraudulent return behavior that is prevalent across e-commerce in India. So trying to be very focused that the returns that we do get are from high quality customers who are truly struggling with product and size and so forth, and doing a lot of work on our end, both in terms of attracting the right customer, but then even after that, weeding out the customers that could potentially have poor return behavior. And the result of that is definitely a return rate that is far better than what we hear and see amongst competition.
Thank you. So there's one last question from the line of Nihal Jam, a follow-up. Nihal, please go ahead.
Yes, thank you so much for that. Just my pending question was that in the quarter, we obviously announced the 3 investments into Rhythm and the 2 other. Just wanted to understand from a perspective of the plan ahead, is this to build up the private label portfolio and that's what the thought is, or could we look at exits for these kind of investments? And would there be more of it, if I were to ask you the same? Thank you so much.
Yeah, I mean, I think what we don't want to do is we don't want to be a fund that invests in consumer companies with a view to exit. I think we would like to build a company which is a consumer company with a number of brands that it owns. Many of the brands are created in-house, through our own organic efforts. And there could be some brands, when we come across certain brands that bring something incremental, or they bring something in an area that we don't have a current focus on, then we may acquire those, but with a clear path to control over time.
Perfect. Thank you so much.
Intention to control. Sometimes the path may not be already laid out, but clear intention to have control over time.
Hi, sorry, I see one more hand raised. Falguni, if that's okay with you to take this?
Yeah, let's take the last question. Yeah.
Yeah, sure. The question is from Amit Sachdeva. Amit, please go ahead.
Yeah, thanks so much and good evening. Sorry, I got disconnected in between, so my apologies if this has been asked earlier. My question is on the e-store business, and I see that there's in 6 months, there's a remarkable progress there as well. But if I do a rough maths and, correct me if I'm wrong, if there are some 18,000 end retailers and revenue, if I just make a rough guess about maybe it's 18-19 crores of revenue has been, GMV has been recorded here. So probably they're, spending about lakh per outlet or some sort. I just want to know that basically what could be the ticket size, what is the total addressable market of those, and what is the minimum efficient scale that you need to reach that it becomes a bit of profitable. I would reckon that because gross margin here would be half of that of your BPC margin because of the trade margins, etc. So how we should make sense of this business in terms of next 4 to 5 years perspective? What could be the size of revenue and probably a trajectory for this business?
Yeah, very interesting question, but these are very early days for us to be able to answer all of your questions with data. A couple of things I can tell you for sure is that this business cannot be done like a B2C business, because like you said, inherently the gross margin available for the business is far lower than what is available for a B2C business. And keeping that in mind, this business will have a very different distribution network. Like it may have warehouses much closer to the retail centers. It may also not be it will also not spend on marketing costs for customer acquisition, especially if it is also spending on feet on street to educate and convert the retailers and teach them the art of buying online. Strategically, I see a very, very big opportunity here, because once you are tied to the retailer, the kind of value add you can do to tell him what are the new products that are likely to sell in his area, and what should he equip himself with, and we can also be that conduit to offer the best offers to them, to the retailer, through our brand partners, and also educate them on the right conversation that they can engage with their clients, and also give them working capital to buy those products, give them knowledge which products and what quantity to buy. So I think it's a very powerful business model. We see that next 10 years of growth will be in this area, and Nykaa can definitely play this very successfully, first in beauty, where we are backward integrating and we are in front of most of the brands, and we think we truly add value for them. And in future, we may also consider a couple of other categories that make sense given our business focus.
Thank you. That was the last question we can take today. Thank you, Falguni, Anchit, Adwaita, and Arvind for doing this call. Thank you, Ankit. Thanks everyone for joining, and hope you all have a good weekend.
Thank you. Thanks everyone.
Thank you, Vijay. Thank you. Thank you everyone for participating.